Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Matt Bartolini, Head of Spider Americas Research at State Street Global Advisors. Matt is joining us from Boston. My producer, Danny, and I are in Chicago, and we are all working from home. We are recording this via a Skype conference call. So again, my apologies in advance if the audio quality is not perfect, but we are trying to do whatever we can in these challenging times. Matt, welcome. Great to have you back on the program. How are you doing?
Yeah, great to be here. Thanks for having me back. Definitely adjusting to the work from home life and trying to stay grounded during these very, very uncertain times.
Yes, that's true. These are very challenging, uncertain times. Let's just hope that all these social distancing measures will be able to slow the spread of the virus and flatten the curve. Now, let's talk about the market a little bit. This Tuesday, the Dow rallied more than 11%. That was its best daily percentage gain since March of 1933. And last Monday was the worst trading day since Black Monday in 1987. And we are talking on Thursday. And it seems that we may be on track for best weekly gains since 2008, or maybe even since 1933. And last week was the worst in many, many decades. So what a difference 1 week has made. What are your thoughts on stocks roller coaster ride so far?
Yeah, I mean, the sell-off has been swift and rapid, and so have these gyrations back to the upside. I think this is very similar to very systemic risk events we've seen in our history, because some of the best days and some of the worst days in the market history have happened within the same time frame, whether it was 1933, 1929, 1987, 2008, and now currently. And I think that's just emblematic of the massive amount of uncertainty in the marketplace that has led to such a swift and rapid sell-off, because we fell into that bear market at one of the quickest of all time. It basically took, around 20 days for the S&P 500 to go from an all-time high into a bear market. And I think it's been a result of uncertainty due to a lack of information advantage. It has created economic uncertainty, social behavior uncertainty, and as a result of not really having a robust amount of information of what is going on and what is the likely outcome, particularly when it comes to the social behavior changes, we saw a lot of investors just do broad-based de-risking. Leverage had already increased prior to the sell-off. So when you have levered investors, a lack of information advantage, this then leads to a broad-based de-risking, and that's why we had such sharp moves to the downside. And now we're starting to see some economic stimulus measures come out, both monetarily and fiscally, but also from a social perspective. I think there's more awareness of the ultimate impact of the coronavirus and what the overall represents. I think early on there's a little trepidation about how severe this virus might be. And I think people over the last 2 weeks, particularly in my neighborhood and in circle, have definitely become more tuned to the heightened ramifications of it. So I think hopefully some of the uncertainty can abate and we can kind of get back to daily routines, but also to see a little bit more normalcy in the marketplace. But very, very hard to predict, and we're likely to still see more volatility.
Yes, as you mentioned, there's still a lot of uncertainty, and it is very difficult to predict the path of the virus. But investors kind of know now that their governments and central banks are committed to doing whatever it takes to overcome this pandemic. So with that, do you think the worst is over? Are we in the bottoming process?
So, I mean, I think it's impossible to say. I mean, we've had some of the worst gains and some of the best gains. Markets typically don't move up 9%, down 5%, and then up 10% again in the matter of a week and a half. Those aren't really well functioning markets. So I think we're going to have significant volatility still, whether that is VIX levels that are in the 60s, they are now, or VIX levels in the 40s, but we're still going to see these sort of episodic volatility events brought on by news flow from something that is seemingly unconnected to any monetary or fiscal stimulus, because those stimulus measures are trying to stem or quell any economic pain as a result of a very social adjustment in terms of how we are living our lives in our daily routine. So it is just absolutely impossible to say. I mean, for anyone that wants to call a bottom, have at it. I just think it would be a big guess, because this is such a socio-economic event that we've never seen before, and it's impossible to model the likely outcomes. I think what you need to pay attention to understand if this volatility starts to subside is basically how the stimulus measures quell that economic pain that a lot of our society will likely go through, and then how quickly we can recover by looking at the flattening of that curve. Those two things taken together should start to bring out an aspect of maybe we're going back to a more normal type of environment, both from a markets perspective, but also from a social behavior perspective.
I agree with you. So, given all that uncertainty, how should investors position their portfolios now? Do you have any particular sectors in mind that look more better positioned than others? Talking about sectors a little bit, technology is still the best performing sector this year, and even the best performing sector is very bad. It is down about 13% this year so far, whereas the S&P 500 index is down about 21%. And energy continues to be the worst. It is down more than 50% this year. So what are your thoughts on sectors or areas of the market that probably investors could look at in this environment?
Well, I mean, I think technology continues to be supported on a relative basis. Obviously, it's down as the broader market is, but from a relative perspective, that is an area where it still is high margin business, strong cash flows, little leverage, and high growth. And I think you're continuing to see investors pay for that growth opportunity, particularly as some of the sub-industries within that may uniquely benefit from this type of environment where we do have more remote access and more digital interfacing among not only just workplaces, but communities. That software and services technology has continued to be sought after to just make sure we can remain connected and try to have more normal sort of socioeconomical behavior. So technology continues to remain an area of interest. I think more broadly, while it's very hard to understand the duration of any negative economic growth, it is likely that we will have some, whether it be 1 quarter, 2 quarters, 3 quarters, that is yet to be known. But we are likely to see a massive slowing of an economic data and growth to potentially be a recession. And in those type of periods, as we have done this research all the way back to 1960, where we looked at sector performance, we had identified that healthcare and consumer staples firms in their sector have performed strongly on a relative basis to the broader market, basically since 1960. And a degree makes intuitive sense because in a slowing economic environment or a recessionary environment, their products and services are sought after. And I think where we are now, you obviously see where healthcare firms are, going to remain a vital part of our economy in terms of providing health and care for anyone that is sick, but also sort of advanced medicine. And then consumer staples, obviously what we've seen from just at the grocery stores, where people are stockpiling on those necessities because we are very unsure of the path ahead of us. So from a sector perspective, technology for growth, consumer staples, and healthcare for defensive recessionary slowdown economic environment plays.
Makes sense. And which are the ETFs you like in particular for software and services? Would you recommend Spider S&P Software and Services ETF, XSW, and within healthcare and consumer staples, do you like the broader healthcare and consumer staples ETFs, XLV and XLP?
Yeah, so those funds, XSW, align with the industry exposure discussed with software and services, XLV, broader healthcare, and then XLP aligning with the broader consumer staples sectors. I think you could also make an argument for broad-based tech to gain exposure to those mega cap companies that do have more quality balance sheets. Think about individual firms like Microsoft and Apple who have little debt loads. So a fund, an exposure like XLK would align with that type of viewpoint.
What about communication services?
So within communication services, that would be with XLC, one of the newer sectors that was created as a result of the GICS change back in 2018.
Okay, so let's talk about unusual market conditions that we have seen in the past few weeks. There were days when even usual safe havens did not provide the safety that they are expected to provide. We saw investors were selling everything from bonds and golds, and of course stocks too. So considering that we may continue to see volatility and uncertainty in next few weeks, if not months, should investors continue to hold some safe investments in their portfolios? And I should add that gold is already up about 8% this year, even though there were days that gold was also down along with stocks and bonds.
So, I think, we would never claim to predict anything in the magnitude or idiosyncratic nature of the coronavirus impacting the markets. But when myself and our chief investment strategist, Mike Aroni, penned our 2020 outlook, we titled it Threading the Needle because we had a feeling that investors would need to balance an assortment of risks. One of them being idiosyncratic macro risks, largely because we had contentious political environment, both geopolitically and within our own shores. And we continue to have discussions around including non-correlated investments. So, rather than not just looking at, the term safe, but understanding that in a macro environment where there's macro risk shocks with episodic and these micro bursts of volatility, having low correlated assets to traditional stocks and bonds may be able to mitigate the equity or bond drawdowns because we knew rates were very low and we knew equity valuations were relatively high. And the good run that we had in 2019 was unlikely to continue in 2020. Now, again, we could have never predicted the coronavirus, but we continue to have conversations from a portfolio construction perspective around the introduction of low or non-correlated assets to traditional market exposures, which would obviously be something like gold.
Makes sense. In fact, it's always a good idea to maintain a diversified portfolio with some assets at least that have low correlations to stocks. And considering that we'll probably see a lot of helicopter money in the coming months, adding some exposure to gold makes a lot of sense. And I think your ETF GLDM, which is the Spider Gold Mini Shares Trust, which is one of the cheapest gold ETFs, is definitely worth a look. And I should add that I hold GLDM as well as XSW in the ETF investor portfolio that I manage for our clients. Now let's talk about the trading volumes a little bit. Some of the popular ETFs like SPY, the S&P 500, the Spider S&P 500 ETF, which is the most popular ETF in the world and the largest, it has seen some monstrous trading volumes. In fact, last Monday, exchange traded products made up about 40% of all trading on exchanges. So tell us what's going on.
So, I mean, more broadly, even just outside of our suite, I think just taking a look at the ETF industry, ETFs are being used to make real-time asset allocation decisions and provide liquidity at a time when investors demand it most. Investors have gravitated towards ETFs as a result of their liquidity profile. And as you mentioned, that has led to heavy increase in trading volumes across a multitude of segments. Not only just equity ETFs, but fixed income ETFs have seen record trading volumes, and they've actually been very highly correlated to changes in the VIX index. So as volatility has increased, we've seen investors sort of gravitate and utilize the ETF structure to make those directional market views. We've seen tactical shifts, particularly when you think about even just looking at not just the secondary market activity, but the primary, where inflows have shown up. We've seen tactical shifts into short duration government bond ETFs. They've taken in roughly $20 billion in March alone, which is a record for any 30-day period. We've seen tactical shifts into certain sectors, both consumer staples, like we mentioned earlier, and healthcare, those two very attractive areas with respect to an economic cycle. But we've also seen inflows into energy, which is sort of counterintuitive given that the energy sector has fallen probably roughly around 50 to 60% this year. And that's just emblematic of the flexibility the ETF structure can potentially provide, because those inflows are a result of a broker or market maker creating shares to then lend them out to another investor who wants to express a short view on the market. We refer to this as long to lend activity. And this also represents itself within broad-based US equity ETFs, S&P 500 ETF exposures, uniquely like a SPY. We've seen inflows as there's been a heightened demand for market hedging vehicles, and ETFs can play that role. So in my view, investors gravitate towards ETFs because they've been additive to strengthening that risk management processes, because portfolio managers can access physically backed liquid market exposure tools that can be sold in the secondary market to raise cash and meet redemptions or hedge particular macro events or the portfolio. And in fixed income, in many instances, they've played a market-enhancing role as price discovery vehicles. Given the challenging conditions in the underlying bond market over the past 3 to 4 weeks, where pricing and liquidity has become constrained, many of those bond ETFs have been utilized to assess where that market should be trading and ultimately be those price discovery vehicles.
Okay, very interesting. So as you mentioned, investors gravitate towards ETFs during uncertain market environments, and investors like ETFs a lot because of their transparency and low-cost tax efficiency. And usually ETF prices are very close to the value of their underlying holdings. But as you mentioned just now, we have seen that many bond ETFs, they saw some pricing dislocations recently. In fact, many of them, particularly high yield and muni bond ETFs, they were trading at discounts to their NAVs. So what do investors need to know about that?
So, I mean, a lot of investors largely view the average discount on ETFs, right now as somewhat of an issue. But I definitely disagree with that. In my view, it's a feature that reflects the fair market price between willing buyers and sellers based on their assessment of the valuation of the underlying bonds, some of which may not have traded recently. So for perspective, at its most basic level, an ETF's NAV reflects an estimate of the value of an ETF's portfolio. Now, in normal environments, that NAV is likely to be fairly accurate. But in a volatile environment like we're seeing now, difficulties in pricing and trading the underlying securities will impact the estimate of the fair value of that basket of bonds. So if an underlying market liquidity becomes constrained and price becomes increasingly opaque, as it has, an individual bond pricing can lag real-time market sentiment and actionable pricing levels. Now, real-time sentiment will show up in the fixed income ETF as market prices move towards where those basket of bonds should trade as dictated by those willing buyers and sellers. So in many cases, the ETF market price may better reflect actionable prices to trade those constituents. And I think there's also a structural component because the bond market closes at 3 p.m. So all the NAVs are based on bond prices struck at 3 p.m. Now, ETFs, fixed income ETFs, additionally, can trade all the way up until 4 o'clock. So the fixed income ETF continues to trade until 4 o'clock. And in this market, we've seen a lot of late breaking market news after 3 p.m. So further to that argument of price discovery, you're seeing dislocations happen between that 3 and 4 o'clock timeframe as the underlying bond market is closed, but investors are making directional views and assessing what that value of bonds would be based on the most real-time market sentiment. And uniquely, given where we are, that's going to lead to discounts because of the volatility.
So how can investors protect themselves from these dislocations? Should they not trade bond ETFs after 3 o'clock, or should they just use limit orders during volatile market environments?
So in any instance, we continue to preach best practices when it comes to execution strategies. Execution strategies, particularly in volatile environments, are increasingly important. Some of the best practices that we continue to talk about are, do not trade at the market open, do not trade at the market close. Basically, the 30 minutes after the stock market opens, 30 minutes before the stock market closes. We also talk about not using market orders, but using limit orders instead to give you a little bit more control over the price that you are transacting at. And a client's trading experience can be improved with working with their execution desks within their own firms or liquidity providers to source liquidity not displayed on the screen. So this market environment has led us to have a lot of educational and instructive conversations around not just what you trade, but how and when, which I think is really important.
That's very helpful. So I wanted to continue this discussion about bond ETFs. On Monday, the Federal Reserve announced that it would start buying corporate debt, including bond ETFs, to inject liquidity in the markets. So what does Fed's purchase of corporate bond ETFs mean for investors?
Well, I mean, I think it's interesting. There were a lot of other stimulative actions that were announced on that day. And I think, maybe rightfully, because this is the first time it's being undertaken, ETFs received a lot of those headlines, even though there was some other headline grabbing news around just buying individual corporates, which the Federal Reserve hadn't done as well. I think with respect to the Fed buying ETFs, there's still a significant amount of details around the program and how it will be implemented. I think when we're having discussions about the meaning of it, I think it just speaks to their inclusion of purchasing broad investment grade corporate bond ETFs within the secondary market credit facility. It speaks to the benefits of the ETF structure that it can provide in terms of the movement of capital. It really sort of solidifies the aspect that the ETF is this systemically important financial instrument that allows investors to allocate capital in a very transparent and rules-based nature that has flexibility because you can trade on the secondary market or the primary market. It has that transparency because of the ability to see into the portfolio on a daily basis, but also has the stability of an asset base where long-term investors are using ETFs in a strategic asset allocation framework where there's little concern that the Federal Reserve, as a result of any purchases, could become a majority owner of the corporate bond ETF market. Like I said, there's still a lot of details that need to be out there. The broad ones that are known is that it's, they're only purchasing broad investment grade corporate bond ETFs. There's limitations on how much of an ETF they could buy. Right now it's 20%. The duration of the program runs until September 30th. And it's in concert with the Federal Reserve buying individual corporate credits from 1 to 5 years of maturity. So it's really, the ETF is almost viewed as a completion portfolio tool for the Federal Reserve to access more of the corporate credit market to improve stability and liquidity at a time where both of those are stressed.
Excellent. I agree with you. Anything else ETF investors need to know about, investing or trading in these uncertain times?
So I think from a trading perspective, and even an asset allocation perspective, we continue to have discussions around discipline. So discipline around your strategic asset allocation, understanding that you had set this for not only good times, but bad times. And hopefully there are, low correlated assets that improve diversification and can mitigate drawdowns, but also discipline around trading. Like we were talking earlier, do not use market orders. Do not trade in the first 30 or the last 30 minutes of the trading day. So it's really in these type of very, very uncertain times, having discipline, trying to not time the market, but have time in the market where you can be offensive and defensive as a result of your asset allocation mix.
Great points. That's all we have time for today. Matt, thanks again for joining us. Let's hope that better times will come soon. Thanks for listening. If you want to learn more about the ETFs that we discussed, please visit ssga.com, and you can also visit the ETF section of zacks.com for more information. Make sure to be on the lookout for the next edition of ETF Spotlight, and also make sure to subscribe. If you have any comments or questions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.